So, hey, welcome back to the Compassionate Capitalist Show. This is the second in the series for Inside Secrets to Angel Investing Golden Nuggets. And today I'm picking Inside Secret number 6, but also one of the quotes. So, within this book, Inside Secrets to Angel Investing, for those that are watching on the video, I have quotes from prominent investors, notable investors that have given up their own insights and expertise to help people understand more about angel investing. So, just after the Inside Secret number 1, which I did last week, if you've not listened to that, go back and listen to that. I got Warren Buffett in here, right? He's an epic investor. We select such investments on a long-term basis, weighing the same factors as would be involved in the purchase of 100% of an operating business. Favorable long-term economic characteristics, competent and honest management. Number 3, purchase price attractive when measured against the yardstick of value to a private owner, and an industry with which we are familiar and whose long-term business characteristics we feel competent to judge. Now, that we'll unpack that, all right? And the Inside Secret, I picked number 6 out of the 44 that are in Inside Secrets to Angel Investing. And it is compliance under the various regulatory laws is an area that I have seen abused or disregarded many times in my 15 years now, going on a few more than that, of working with entrepreneurs and investors not familiar themselves with security laws, naively, assume the company has dotted its I's and crossed its T's. Experienced investors have the discipline to ensure that the company is currently and in prior endeavors in regulatory compliance. The reason why that's important to go along with Warren Buffett. Now, Warren Buffett primarily invests in public traded companies through his big fund, and then he acquires companies. Right? So he acquires outright companies. That's why he talks about that blend in there. So one of the first things I tell investors, and I talk about it in the book, is that you need to invest in things things that you have a reasonable expectation of knowing that industry, what you could expect in that industry, either because of your job in the industry or the company you currently own in the industry. The kind of investors that get the most benefit out of this particular book, Inside Secrets to Angel Investing, are those investors that are savvy real estate and stock market investors, and they're high level within a company. They might be just a regular W-2, could be a VP, a C-level exec, somebody making hundreds of thousands of dollars a year and accumulated wealth within their 401k, and have some wiggle room there to diversify that investment through other shows that I've talked about, or we've had guests on here on self-directed IRA and Roth IRAs, and being able to have, the ability to direct that, then where your investment dollars are going to go, right? And those people that, own a small business, they might be something very comfortable in a lifestyle business, might have a profitable restaurant, or a couple of restaurants. They might have a profitable service industry business or some, small manufacturing business that never really was angel backed or never got VC money. And now they want to diversify, as I talk about in the cash flow quadrant, being able to be a business owner that the business makes money for them, whether they're there or not, right? And so before they get ready to think about selling it or anything like that, or if it's something that's going to be generational for the next generation to take over that business, they take a chunk of their money their excess money and they invest in other businesses. They diversify by investing in other businesses and having their money work for them. And that's kind of where compassion comes from, because the company, that entrepreneur, is very passionate about what they're doing, and they're going to work really, really hard to make sure that they're successful in their business, as successful as that person is. And so if you're a executive in a company that has this itch to, because you've got limited options to go up, or you just like your job, you like the benefits, but you like the idea of being an entrepreneur. And one of the things about entrepreneurism is a lot harder than a lot of people think it is, particularly if they've been a part of a company that they've been a W-2 and they've had staff and they have resources and they have a budget and they have things like that. Running your own company is a lot different. It's a lot harder. And so that's why people diversify. And the story I talk about in the beginning of the book is a very example of one of my investors that was in that position and decided to become an angel investor. And it was, pretty exciting for him. And he appreciated that, and he appreciated learning what I had to teach him about becoming an angel investor. So, that's part of the motivation and who most benefits. But then there's also this sort of rise of the millennial that likes to invest in crowdfunding companies, because it's a lower threshold of the amount of money they have to put in per company. They can diversify very easily within a year. Even Jason Kokonis talks about it on a podcast he interviewed with the founder of Seed Invest, that if he could do over what he wished he could do over, if he could do over, what he knows now, go back, talk to his younger self, he would have started investing in crowdfunding companies if it was today and that was available, rather than taking all the risk of starting his own business when he was very young. So there's a lot of millennials out there that are thinking that same way, and they don't qualify on the threshold. So they have to invest in things that are a little bit smaller threshold of what they can invest in. But all of those, you're going to benefit from these two things. So let's break it down. All right. So part of what Buffett talks about is the factors involved in purchasing of 100% of an operating business. Well, the things, yes, there's these 4 points, but you want to look at the management team. You want to look at the financials and what they've been doing with their money. How have they run? What's their cash flow and run rate? You want to be able to look at, what their growth strategy is, what their partnerships are, what's their channel, just like you do with a public stock, you want to look at their ratios, and that's really that kind of a conversation is geared to companies that aren't pure startups. Okay. They're ones that are raising money under a Reg A plus or a 506C or even an intrastate, because they're the ones that have an operating business that are seeking capital to grow that they can't get from other sources like VCs or traditional angel groups or private equity funds or banks, sufficient to launch that next line of products or to expand into other marketplaces. So you want to be able to look at them that way, and they should be forthcoming to offer that information up. It should be available through some kind of password secure access on their website. That's what we do. We don't want to be passing these documents all around on email. We want to be able to control who gets access to these, and that these are serious investors. That's how the advice I give entrepreneurs, because it's very sensitive information. It's their operating information. So you don't want to just give it out to anybody. You want to give it to the people that are going to be serious about investing. And you as an investor need to be serious about looking at that, doing your due diligence on that, and making a decision in short order. I talk about that in the book. That's good practices by angel investors. Competent and honest management. Okay, favorable long-term economic characteristics. So you want to be in an industry that's growing. You want to be in an industry that is ripe for a transformation or a shakeup. There might be some older companies that have been around for a while, but there's innovation that could change that. If you're in an industry and you say, gosh, I wish that there was something like this, or I see these other things, and even sometimes corporations will invest in these kind of companies. They're not startups. They invest in operating businesses because they want to get an insight into what they want to get some insight into what's happening in their industry. When I was running my angel investor group, the folks from the UPS equity fund would come to our meetings to look at these companies. They would never be first money in. They would always follow the angel round or be a part of the VC round, or they look at it independent of that. IBM does it with some of their software companies and some of the companies that they end up partnering with. But when they see that, they'll invest in them just so they've got insights, because then they understand the industry and what the impact of that innovation is on that industry. So you think about what it is, what industry also, could be a life experience. If you're into certain kinds of sports or certain kind of leisure activities, you might want to invest in things along those lines that are something that you wish there was a product and you can't find that product, and then you find a company that is doing that, or a company that has come out with something and they're struggling to get it well known, and them and they're really small. You should look and see if they're doing an offering. If they're not doing an offering and you would want to, reach out to me, because I can help y'all solve that problem, right? But the thing is that, you want to look at the long-term economic characteristics of that. And a big part of it is the scalability. Sometimes you need to look at what is it they're going to do to scale. If they have a very labor intensive scaling thing, or a very capital intensive, what are some innovations that they can use to be able to grow? Or will that be an impact that limits their ability to grow? And long-term economic characteristics are also, what is the likelihood of them being acquired by somebody else in that industry, somebody that maybe a company that of that does a lot of acquisitions. When it comes to competent and honest management, you want to make sure, and this kind of goes back to the regulatory piece, and I'll bounce back and forth on that. So one thing is honesty, is that they're really forthcoming with their books, that they've allowed an accountant to look at it. The accountant has certified them. They don't necessarily have to have fully audited. If they're doing a Reg A plus, they must have fully audited financials for SEC audits, but it's really expensive to get fully audited. So private companies often don't do that, but they may do a review with comments. Then you look at the comments at things that the accountant looked at that are that are weird or something in there that they might be, they need to address on the legal side. And the reason why you go with the accountants and the legal on this is because they're licensed. They lose their license if they lie in the reports that they do. So they're a good source of information to make sure that they've done that. A company that's serious about raising a lot of money, particularly an operating company, they should have that. I don't work with companies unless they're willing to do these kinds of things, because anybody that's investing in somebody that's general soliciting like that, if you're investing in a business down the street, then that's another thing, and the owner. But even then, when you know the owner, you need to ask this stuff, because sometimes we think, well, I just know that guy and he seems like a really nice person, or he seems like he's really honest in everything that he does, but you just never know what goes on behind the scenes, or what somebody might have done in a crunch. Like, let's just say we've just gone through a pandemic. There's been a lot of people that took money as part of that may not have used it in the right way that they were supposed to use it. I've had encounters with clients that have come, and then I discovered that they weren't paying their payroll taxes because they got into a financial crunch and they just didn't pay it to the government. It puts them into a real stitch. Now, all of these things are fixable, but they usually take time and money to fix them. So then you have to choose, do you move on to another deal, or do you like that deal so much that you want to invest any time or money in it to help them get fixed, right? So you want to make sure that they have that competent and honest management. And when it comes to the regulatory side of that, my number 6, most angel investors, compliance under the various regulatory laws is an area that I've seen abused and disregarded like so much. And investors not familiar themselves with the security laws I got that. Why should I put that word in there? It's so hard for me to pronounce. Naively assume that the company has dotted its I's and crossed its T's. Okay. Experienced investors have the discipline to ensure the company is currently and in prior endeavors in a regulatory compliance. Where this happens, okay, yes, there's tax laws and things like that, but where it really becomes a stickler of late is in SEC laws and use of finders, for example, where they're paying somebody that's unlicensed to be providing them, this and taking a percentage like a broker dealer. They're operating as a broker dealer and they're not licensed as a broker dealer. There's, depending on when you listen to, they may have changed the laws on that because there's some ideas or things pending from the SEC to establish a certain way that some finders can do. And sometimes an intrastate, when they're doing something on an intrastate, like that means where they're located in the state, selling equity, soliciting investors from investors that reside in that state, they can general solicit, they can do a direct public offering to those investors. And within that, then they have to, there might be some paperwork they have to file with the state. If they're doing something to get tax credits, they have to make sure that they have filed the proper paperwork. They can't just say they have that. We had a real problem when crowdfunding or when the Jobs Act first came out, and some people were saying that they were doing a crowdfunding raise, but they hadn't filed any paperwork. And the SEC frowns big time on the use of founders and the use of doing general solicitation, but you're not authorized to do general solicitation. You haven't filed the proper paperwork to do general solicitation. Because if a company solicits, so where this happens, it's a gray area, and it happens all the time now and more so, it was worse before the Jobs Act. People would stand up at these pitch events and they would pitch their company to an audience of 100 or 200 people. And they would say they were raising capital. They would say how much they were raising capital. They would give all the terms of that. And that's a no-no. That's operating as a public company when you're a private entity. And the reason why that's a problem is because they haven't filed any paperwork with the government to say that they should general solicit. That's where it gets it. And I have other podcasts that I talk about that, other things. I think the transparency one, I talk a lot about that. I've talked about that a lot. If you listen to any of my 200 some odd episodes, you'll find one of those. Just search in the player that you're looking for that kind of stuff and you'll find it. Okay. Or go to my blog, KarenRands.ca/blog. Easy to do the search button there and find the episodes and then, listen to it there. But it's, those are where people get into a real bind, and it may never be a problem unless the company starts to go south, or if they brought in investors when they were desperate and they made all these special terms for them. So they've violated the cap table. The cap table, one of the rules is that you have to be fair and equitable to all investors. And so if you do a down round and you've devalued the company, then that's an issue. If you raised money in all different kinds of ways just because you were desperate to get the money, then that's another issue. Sometimes in the issue of transparency, they have taken out loans that they don't have on the books of the company, but they expect to use some of the money that the investors put in to pay off those loans they need to be in the company name, or they need to have promissory notes that they've written to the company that's documented. There has to be a paper trail on all of that money. Otherwise, they have to take it out of their salary or their bonuses. They can't take it from the company when it's not a company expense or documented as a company expense, right? And so that becomes an issue on that. And so, there's all kinds of things along those lines that can be problems if they're not competent and honest. They didn't get the proper advice along the way. We see this a lot of times with companies. There's a lot of things that can happen, that they do along those lines. And so, the experienced investor will ask how they raised their prior rounds. And you want to know, how are they going to raise their next round? Are they raising enough money right now? Where are they robbing Peter to pay Paul on some of this stuff? Those are the kind of things. Have they promised shares to somebody that they've not issued to them? Look at what happened with Facebook, right? Even though that got all worked out, it still cost the company a lot of attention and as well as money to pay off those original founders that had been part of that business, and they didn't have the proper paperwork, right? So all of that stuff is stuff that you need to ask about, right? To make sure they disclose it to you and record that, so that in the event that something happens, you can show that you had it, because that becomes fraud on the founder's side or the C-suite side that says they have they left out mitigating circumstances or mitigating information that would have affected your desire to invest in that company. And if they say they have a contract they don't really have, You know, in my last episode on Inside Secrets, I talked about some of the legal issues that they may face. So the third point on Buffett's model was purchase price attractive when measured against the yardstick of value to a private owner. Well, that's a fancy way of saying the valuation. What's the price of that stock, right? So when you ask for the cap table, the capitalization, how are they capitalizing the business? That's what it stands for. One of the things, and I should say, by the way, in the book, I don't know, there's like 100 pages of a glossary, which is also found in the resource portal that comes with the book. So you can print that out and look at it, search on it, do all that kind of stuff. When there's terms that people use in the space and you're not quite sure what it is, you have to Google it. You got your own resource thing right here in the book, right? So anyway, cap table is the capitalization table. And that is, you know, like for example, when Amazon first started raising their capital for their company, Jeff Bezos, he started out like at 15 cents a share. Then he went to 25 cents a share. Then he went to 50 cents a share, then $1 a share. Of course, when they went public, it was, you know, I don't even know, $20, $30 a share, right? So that's, so every time he sold stock in the company, the value of the stock went up. So therefore, for the same amount of money, the investors got less stock. But it's that money that goes into those companies that sets the value. It's a thing called pre-money and post-money valuation. And that's one of the reasons why these things that are unicorns, that are private companies still, oftentimes are disappointing when they finally do an exit, because they don't actually have a true valuation worth the $1 billion. You know, what was Snapchat's revenue to become a $1 billion company when they decided to go public? That $1 billion value was based on the money that had been put into them, not based on any actual performance data. And so when you go to look at, you know, when you go to invest, you need to understand that you don't be afraid to be like, it's okay if it's $5 a share or $20. Look at it at the price per share. Don't look at the equity that you get in the company, what percentage. Angel investors that are investing in startups get all obsessed with this percentage of the company and anti-dilution and all that kind of stuff. That's the other provision you need to look at, prior documents of how they raise money. Do they have anti-dilution in there? Because that will affect how much stock is available. If they can't dilute that 15% that they originally raised, and so that 15%, if it was $1 million, it got them 15%, but that always is 15%. And now they're raising it affects the rest of the value of the company. And it harms the company's ability to raise capital. And the founders will end up, when you hear these horror stories of where founders end up with 10% of their company, and they feel like they're employees and not founders anymore. They're working for the investors and not for their future, because 85% of the capital has been given away. A lot of times it's because of anti-dilution provisions that have been put in there. So when I've invested in companies, the companies come back to you and say, we're doing another round. If you want to maintain your percentage share, this is how much money you have to put in to stay in this round. Otherwise, you're diluted. And I put more money in, right? That's one of the, I didn't talk about it here, but when your venture funds, angel investors, angel groups, any angel funds, they always have a set aside that they call dry powder. That means that they're going to be able to continue to invest in that company to maintain their share in that company, but also when that company might get into a little bit of a bind and they need a little money. A great example, the kind of companies that we work with are companies that raised an angel round, maybe a friends and family round, and a series A or a seed capital round of a couple million. They built the company up to 3, 4, 5, 6, $7 million in revenue, but they missed the VC round, and they're too big now to go back and raise 5 million from those angel groups. And those angel groups never put 5 million into company. They put 200,000, 300,000, numbers like that into companies as an angel group. Entrepreneurs have to raise money from multiple angel groups to get their first 2 million or whatever it is, usually, right? So when they're looking at it, they can't get it from VCs. They're too small because most private equity funds, minimum of $10 million in revenue and about 2 million in EBITDA. And they can't go to a bank if they only got 5 million in revenue to get 5 million, right? You can't do that. So where do they go? Well, that's the beauty of the Jobs Act. There's some places for them to do that. Talk about that in another podcast, but there's places for them to do that, right? And they can raise that kind of capital. And that's where it gets to what is the value of the stock, not the percentage of, right? And do you think that when they go to exit, will they get big enough to be able to produce what you have decided is your minimum return on investment over that period of time, the IRR of that, right? Most angel investors look to get 34% IRR, and that goes down over time if they're, it takes them 10 years to do that. But if that company, if you pay $5 for the share, and when that company gets acquired 5 years down the road or 3 years down the road, and they went from being a $5 million company to a $20 million company with 5 million EBITDA, and they can get a 6x, 9x multiple, your $5 is going to be worth a lot. Your $5 share is going to be worth $20 shares or $25 a share, something like that. So, that's how you look at the purchase of attractive when measured against the yardstick of value to a private owner. Where are you going to be able to go with that particular thing when you exit? All right. Last one, an industry with which we are familiar and whose long-term business characteristics we feel competent to judge. That goes back to, the investing what you know, and investing something that you're passionate about, something that the whole compassionate capitalism. The reason why I started the compassionate capitalist movement was so that I wanted people to add investing entrepreneurs to their asset portfolio the same way that they choose to learn how to invest in stocks and running their own stocks and not be dependent on a wealth manager or financial planner to pick their stocks for them. They want to or limit what they see because that's all that broker dealer deals with or something like that. They wanted to be able to, they invest in their own real estate, right? I compared a lot to investing in real estate and what you might think of as a flip or a reoccurring revenue stream of rental properties or commercial real estate, and what you get from that versus a long-term play, so those are, but entrepreneurism as an asset class has been the redheaded stepchild forever, mostly because of the regulations against it and this exclusive club of high net worth accredited angel investors that, based off of geography or industry would sometimes, or quite frankly, sex and race. They would exclude other people from entering into, or not really exclude them, but they wouldn't make them feel comfortable or embrace their participation. Now that's changing a lot in the last 18 months since the summer of 2020. But that is still something that, has been, so there's been a perception of that. I can tell you right now, in my angel group that I ran, I was the managing director of it. And very often I was the only woman in the room. And very often there was just maybe one or two folks that were not of the same skin color as me. And so, that's just, it wasn't for lack of trying. It wasn't for lack of whatever. That's the education. That's why, another reason why I wrote this book, right? Because I want everybody that has the discretionary income to be able to participate in what is the second greatest way to create wealth. And that is by investing in entrepreneurs. You don't have to be the entrepreneur that assumes all the risk of starting a company and growing a company if you can be an investor in an entrepreneur, because the only thing you lose is money. And if you do it right, if you have discipline in your process that you go through, if you establish a criteria, I have a spreadsheet that I hope to create into an application for my gold members that you can evaluate a deal with. I'm working on that. So when you buy this book, Inside Secrets to angelinvesting.com, then you will get access to the resource portal, and you get a free membership at an entry level to be able to come to me with questions to be able to talk to me about helping you with things. And then there's options for upgraded memberships for more benefits, right? So with that, I want to tell you, thank you for tuning in again. Please give us a thumbs up, share this with somebody that you think would find value in it. And please do yourself a favor, invest 20 bucks. If you're thinking about getting started in angel investing, get the book. It's the best-selling financial primer, financial investment book on, well, not all the time. It hit it twice on Amazon, but it's a good read. It's a hard read sometimes. It's thorough. Okay. It's got a lot of content in it. It's not a fluff book. But hopefully you'll find it really worthwhile. And I'd love to get some feedback from you on that on Amazon as a review. And with that, get ready. Next week, we're going to be going into Inside Secret number 7. Onwards and up.